Good afternoon, everybody. Thank you for taking the time to join us today. My name is Heath Birch. I'm one of the private wealth advisors here at CommunityAmerica and a part of the team whose responsibility it is to deliver wealth management and financial planning services to CommunityAmerica's members. As we approach the end, excuse me, of what's been a really strong year in the equity markets, we just thought it'd be timely to provide our members and clients a view of where the markets are currently, and then also take a look into the new year and how you might position yourself as investors. So we'll take a look at where the markets stand today. We'll take a look at the state of the economy and things that we see there. We'll talk a little bit about the likely continued shift in interest rates, and also review from a historical context just the impact elections can have on markets. And without any political comment there, it's not a question of who wins the election. It's more an understanding of how elections can impact markets and how we might position ourselves again as investors. And then all of that kind of lead us into how we should look at 2025. So this won't serve as a firm prediction for us. That proves difficult anyway, but really just a conversation of where we currently see things and then how we might react to that as we transition into the next year. We're going to leave the Q&A open today. We won't be answering questions during the webinar, but we'll keep an eye on those, and we'll try to preserve some time here at the end to address a couple of the questions that you add to that. So with that, I want to bring in our guest, Michael Laughlin. Welcome, Michael.
Thanks.
He is the head of the portfolio specialist team at Morningstar. So ultimately, the team responsible for providing investor and advisor insight and education. He's also a certified financial analyst. Any of you who understand what that designation is also understand that brings a certain bit of credibility. But many of you are probably familiar with Morningstar, an important partner of ours, really maybe the leading provider of investment research and insights across the globe, but also an advisor on assets approaching 300 billion in assets under advisement, including for a number of our clients. So with that, I will step out of the way, Michael, let you take over and then come back in and join you at the end for a couple questions.
Yeah, awesome. Thank you, Heath, and thank you everyone for the time. It's really a pleasure to be here, and we so appreciate the partnership that we have. So thank you for the opportunity today. As Heath mentioned, we'll talk a little bit about the markets and sort of where we've been, where we see things headed here. I think the good news is that we see a lot of green on this slide, which is fantastic. So this is a representation of broad asset classes in the US, outside the US, stocks and bonds, and a lot of green everywhere, kind of the opposite of what we saw in 2022. It's been an interesting year so far. We've seen a continuation of some trends that we've been seeing over the last few years, maybe a little bit of a reversal of some of the others. So far, year to date, we've seen large cap stocks, and whether you look at that as the S&P 500 or another large cap index in the US have continued to really lead the way, with the S&P posting north of 20% year to date, which historically would be a strong year for the S&P. Long term, the average return is about 10%. So the fact that we're north of 20 and it's only late October is a great sign. Also, the US has continued to outperform international stock markets so far this year. Although surprisingly, emerging markets, and if you can see my cursor here, it's sort of highlighting emerging markets, more recently have really come on quite strong, especially China. Now I know China can be quite a polarizing portion of the world, so please don't throw your coffee at your monitor or anything like that. Just kind of reporting in the last quarter, in the third quarter, Chinese stocks did quite well. And so we've seen emerging markets really make up a lot of the return gap relative to the US here over the last couple of months. The other interesting shift that we've seen is this year, actually value stocks have started to outperform growth stocks a little bit. And I think this can be surprising, over the last number of years, growth stocks, especially parts of the technology market or any of the companies associated with artificial intelligence have it's been a great place to be and have, dramatically outpaced other parts of the market. But, in Morningstar's opinion, if we were looking forward, we do think some of those parts of the market are starting to look, fairly valued, if not maybe overvalued. For instance, in Nvidia's last earnings, they beat analyst estimates and the stock fell 7% that day. So you can have parts of the market that are, maybe priced beyond perfection, if you will. But we've actually seen the value side, the kind of those stocks that are trading at more reasonable valuations are actually outperforming the growth stocks year to date, which is an interesting shift. On the bond side, interest rates have come down a bit, and starting from a place where the yields were already a little bit higher, and so we're seeing pretty positive returns in bonds overall. In Morningstar's portfolios, in sort of 2021, 2022, when interest rates were basically at rock bottom lows, we didn't really see a lot of value in bonds, either for return purposes or honestly for diversification purposes. We'll talk a little bit about interest rates, but as that picture has dramatically changed over the last 2 years, in our portfolios, we actually do think that fixed income can play a meaningful role in return and risk mitigation, which is, when you think about a 60-40 portfolio, 60 equity, 40 bonds, that 40 bonds being able to provide that diversification is a really important attribute. Overall, though, Morningstar's kind of opinion, even though we've seen really positive returns here, I'll just use our 60-40 as an example. Today, we are bang on 60-40. So we're not overweight equities, we're not underweight equities. We're really right kind of down the middle of the fairway, if you will. And I think that's kind of where you want to be in a time like this. And I'm sure, working with the advisors that you work with, putting together really high quality plans, thinking about the long term. We'll talk a little bit about that as well. But I think today's a period where there's some uncertainty. Uncertainty is not the same thing as negativity or bearishness, but it does, in our opinion, mean you just kind of don't stick your neck out as far in some places maybe. I think it would be interesting for people to learn that the top performing sector this year is actually utilities, which is really interesting. Kind of historically a sleepier sector, a more defensive sector, a heavily regulated sector as well. So it's unusual for utilities to be one of the top performers. Now, they have certainly benefited from interest rates falling. Utilities have also benefited as kind of you can think of it as almost like a secondary AI play, where I mentioned some of the primary AI plays look rich and look expensive to us. We know that the data centers that need to power AI need energy and power themselves. So there's an expectation and a realization that there's going to be a significant increase in demand for electricity in this country. And some of these utility stocks have benefited. If you were to look at Morningstar's dividend portfolio, we've actually been overweight utilities in that portfolio, and that's really benefited our performance, but kind of really as a secondary thematic sort of AI derivative play, if you will. The second performing sector is communications. We've had an overweight in our multi-asset portfolios to communications for some time. You do find companies like Google and Facebook, or I should say Alphabet and Meta, in the communications sector. They're actually not in the technology sector anymore. But communications is the next highest performing sector. But overall, all of the sectors are green, which is really great for everybody here. If we look at sort of both stock and bond returns, this is obviously this year, the S&P 500 here, this US ag is fixed income. So the blue is equities, the red is fixed income. And you can see this is 2022, obviously, 2022 was the worst year for a 60-40 portfolio on record, the worst year. And the reason for that largely was that the bonds were down almost as much as the stocks were. You can go back, this is 2008 over here, this really deep negative blue bar, but at least in 2008, your bonds were still positive. And so it is unusual to see bonds and stocks down together to such a severe level. But it also speaks, which we're going to talk a little bit more about, that these things can be very difficult to time. And fortunately, everybody here, like I said, works with really high quality advisors. You have a long-term plan and you're sticking to that plan. I think there's a lot of investors out there that, kind of panicked at the wrong time and have missed a couple of great return years in both stocks and bonds in 2023 and so far here in 2024. Now, we can kind of take a tour of the economy itself. I think in our view, the US economy is in good shape. It's healthy right now. You see, our current GDP growth is around 3%. We think this will continue to maybe slow a little bit, but remain positive. So our base case is for us to avoid a recession. We'll talk a little bit more about that, but a 3% or even kind of a slightly below 3% GDP number is very healthy economic growth, we think, at this point in the cycle in the United States. So that is, I think, the first sort of backdrop is there is economic growth is happening, and it's actually a pretty reasonable cushion of growth that is happening. Obviously, it's hard to talk about markets without talking about inflation. What you're looking at here is the Consumer Price Index, or the CPI. Now, I know I'm a consumer as well. I think about prices cumulative, right? Cumulative, meaning, is my grocery bill higher than it was, 4 or 5 years ago? Undoubtedly so, right? Undoubtedly so. We went through a period of, high year-over-year inflation, but you can see it's falling pretty precipitously, actually. And so, while I say, and probably folks on this call say, hey, I'm looking at inflation cumulatively, the Federal Reserve is looking at the year-over-year change. And that's really important for how they think about setting interest rates. But the good news is the year-over-year change continues to fall. Now, the last mile is always going to be the hardest, right? So, hey, we're roughly at 2.5 or 2.4 today. It's going to be that last little bit to get to the 2% target is going to be probably the hardest bit. But we've come down significantly from where inflation peaked just a couple of short years ago. So I think the takeaway here is that the actions that the Federal Reserve took, raising interest rates, have really started to win the battle, let's say, when it comes to CPI. Actually, not shown on this chart, but maybe an interesting statistic. The New York Federal Reserve, does this supply chain pressure index, basically. And so that measure is like essentially like looking at how strained supply chains are, is basically back to where it was in 2019. So we also think we've really worked through some of the supply chain issues that were causing a lot of the goods inflation, over the last couple of years in the wake of the pandemic. So positive news on economic growth, positive news on inflation. Unemployment, you may have seen the headlines, has been recently increasing a bit, which is a concern and is something that we are watching carefully. I think it's also important to recognize, though, that unemployment was already quite low. Today, if we're looking here, about 4.2% is pretty low. The other thing when it comes to unemployment that we look at is the increase in unemployment being driven because people are losing their jobs, or is the increase in unemployment being driven because there's more workers entering the workforce? And to us, it seems to be more of the latter at this point. There's more workers entering the workforce. If you actually look at, if you kind of were to, we have this 4.2%, if you were to kind of decompose it into kind of the sources that make that up, the rate of layoffs that's happening today is actually below the historic average rate of layoffs. It's below the rate of layoffs back in 2019 before the pandemic. And I think that's really important because ultimately, right, if I get laid off, my consumption is going to change. I'm going to spend less than I'm spending today because I no longer have a job. My spending less may lead to somebody else losing their job. And that's kind of where that vicious cycle can start. But today, while unemployment has crept up, the rate of layoffs is still actually below the rate of layoffs before the pandemic. And so that's what kind of gives us some confidence, at least, let's say, we're watching it, but we feel reasonably good about we're not overly concerned about what we're seeing thus far in unemployment. If you put all of that together, and really, I think this chart on the right does a pretty good job of kind of laying out what are the different states of the economy, right? You can have an economy that's overheating. You can have an economy that's stagflating, which means growth is low, but inflation is high. You can have a recession, which means that growth is negative. Or, you've probably heard this sort of term soft landing. I would think of the blue circle as just kind of that happy place, not too hot, not too cold. Just that's where we want to see things. And you can kind of see the dark circles here are where we were over the last few years in terms of inflation and GDP. And the unfilled circles are where Morningstar thinks we're going to be over the next few quarters. And so you can kind of see the journey that we've been on. We had an economy that was growing very, very quickly, but we had inflation that was, 7%, right? Very, very high. So you can kind of see that we've retraced a lot of that. Now, our base case being that soft landing is why I say I think everyone on this call should feel pretty good, pretty optimistic. I know markets are sort of like hitting all-time highs. That does happen. But I think we can be pretty optimistic about the state of the US economy. That doesn't mean that the range of outcomes is still not wide. We could end up in a scenario where the economy goes back to overheating. I think it's possible we could still end up in a scenario where we dip into a recession. But I think those are kind of more extreme outcomes today. And it seems likely that we'll be able to sort of live again in this happy blue zone here for the next, let's say, few quarters or year or so. These are Morningstar's expectations relative to the broader market for both the GDP and inflation. GDP on the left, inflation on the right. As I mentioned, we do think you could see a slowing of growth in the US in the short term. And some of that is driven by, rates are still high, and just because the Fed cut rates by 50 basis points, it's not like, there's a magic wand and that immediately propagates through the entire system. Like, these things operate with a lag. They take time. So, the fact that we had rates so high and the fact that rates actually went up so quickly, that still needs to maybe be worked through in the economy in the short term. So we do think we can see growth sort of slow a little bit before re-accelerating, in 2026, 2027, 2028. I will say, in general, we hold this view regardless of who wins the election in the next 2 weeks. The one issue that we will be paying very close attention to as a result of the election with respect to the economy is the issue of tariffs. Tariffs are more traditionally associated with Trump administration. However, in the Biden administration, we saw a lot of the initial Trump tariffs from 2016 administration actually continued. And just about a month ago, the Biden administration did enact new tariffs with respect to China on electric vehicles, lithium-ion batteries, solar panels, steel, and aluminum. So it's not just a Republican or a Trump issue, although I think it is maybe a little bit more so. It's not only. Again, not making any commentary on Trump or Harris or their candidacies or any type of prediction. But the one area as a result of the election with respect to the economy that we're going to be watching closely is what actually does happen with tariffs, because the president does have somewhat unilateral power when it comes to enacting tariffs, especially anything that has to do with national security. So we do think that tariffs decrease productivity, decrease growth, increase inflation, increase unemployment. And so that's going to be something that we are watching carefully. But outside of that, this growth trajectory and inflation trajectory that we are on, we don't really necessarily think is dramatically altered in the short term by one candidate winning or the other. On the interest rate front, so I would say we expect the Fed funds rate, which is the short-term interest rate that the federal FOMC basically sets, We expect that to continue to come down to about 3% by the end of 2025. Now, whether the Fed starts to do that in 25 basis point or 50 basis point cuts, how they get there is still maybe a little bit of a question mark. But we expect the that Fed funds rate to be about 3% by the end of 2025. We then see the 10-year Treasury rate, which is a longer term rate, not set by the Fed, set by the essentially the market, declining. It's actually even a little bit higher than the 3.8 listed on this chart here, but declining to around 3% in 2027 and beyond. And this is one of the reasons why we say, hey, we actually think bonds can play a meaningful role in your portfolio as well. You can maybe start to kind of extend something called duration a little bit, or you don't have to be so front end focused. I think having front end fixed income still makes sense heading into 2025. But you can actually start to maybe get a little bit more ballast, extending out a little bit. And some of our multi-asset models are starting to do that. We also are starting to, in our models at Morningstar, we do sometimes use what are called alternative investments. Now, you can use alternatives for diversification, or you can use alternatives for amplification, meaning like really return seeking. We pretty much only use the diversification variety. And we use them when fixed income to us looks unattractive. So in 2022, as a result, our models were significantly overweight alternatives, which really actually benefited our clients because, as we saw on the previous slide, bonds got whacked almost just as hard as stocks did in 2022, and that alternatives gave us a nice buffer. But actually now the picture has changed quite a bit. We've been reducing our alternatives exposure and just going back to kind of plain vanilla down the middle of the fairway, high quality fixed income, because you can get paid, and with the expectation that rates are coming down, that benefits as well. So that's kind of a little bit on how we're positioning our portfolios. Now, I mentioned the word recession, and look, recessions are kind of a fact of investing. The sun will rise, water is wet, and eventually there will be a recession. We don't know when, but it is just a fact of, it's part of the volatility that you accept for being in the market. I think an interesting question for any investor on the call who has any sort of a longer term time horizon. And look, I'm 36 years old. I have at least a 30-year, probably working time horizon, hopefully, a 50-year life horizon. So I have a very long horizon, if you will, for the money that I'm investing today. And, even if you are retired or in your 60s, folks are living longer than the past as well. So, you may be retired and have a 20-year time horizon still. I think it's important to ask the question, hey, do recessions even matter? And I'm saying that a little bit tongue in cheek. They do matter. But from a return standpoint, if you look at all of the previous recessions, this goes all the way back to Eisenhower into the early 1950s. And if you look at these columns on the right-hand side, 3 years out and 5 years out, basically markets are always positive, 3 years out, 5 years out. And so as long as your time horizon is at least 3 years or 5 years, I will make the caveat that if you retire right at the beginning of a recession, that can put a lot of stress on the portfolio, because it will have a decline and you're starting to withdraw money at the beginning. There's something called sequence of returns. So it matters quite a bit, the timing of that, if you're sort of like just retiring. But outside of that, if you have a 3 or 5 year plus time horizon, it's painful. Nobody likes living through seeing their portfolio decline 20 or 30%. But I think a lot of investors have done much more harm to their portfolio by eventually becoming emotional or capitulating or trying to time. There's a lot of market prognosticators, let's say. There's a lot of people who have predicted 9 of the last 2 recessions, if you understand what I'm saying, right? And I think that type of behavior is much more likely to do long-term harm, impairment to your portfolio, than just riding out the recession itself. 3 years is not that long. 5 years is not that long in the grand scheme of things. I mean, in many cases, the market is positive 12 months after the recession. So again, fortunately, working with great financial advisors, putting together great plans sometimes I think, where an advisor provides the most value to an investor is just helping people at these really emotional inflection points. But I just want to ground everybody again in some of these numbers, because as long as you kind of have that time horizon and you don't sort of succumb to that emotional, trigger of, wanting to sell at the bottom of this, I think you can kind of just ride any recession out. Now, I mentioned emotions, and I cannot personally think of anything that is more emotional today than money and politics. Like, to be honest with everybody, I'm just grateful I don't have to talk about religion in this presentation too, because, it is true, right? And as a result, I would say, I think the next few weeks and maybe next few months, I think are just a really behaviorally dangerous time to be an investor. It's hard. It is hard to not connect the emotions of money and the emotions of politics together. But that's what we're going to talk a little bit now about, some of the historic data around elections and markets. The good thing about elections is they actually, there's a lot of them, right? They happen every 4 years. But yeah, we'll see sort of some of this historic data that I think maybe can help. If you're aware that these behavioral biases may creep in ahead of the fact, like that's how you guard against them. This right here are the current betting odds for the presidential election. So anything you see in the dark blue is a Democratic sweep. Anything in the dark red is a Republican sweep. Anything in the lighter color would be a divided government. And this is the plurality outcome here, is actually a divided government. That scenario also probably chops some of the more extreme, let's say, policy tails from either party, right? If we're in a divided government versus a sweep scenario. But these are the current betting odds today. Now, Morningstar, our approach to this is to prepare, not predict. Prepare, don't predict is kind of a mantra that we live by. And what that means is we have no skill, we have no edge in telling anyone here what's going to happen in 2 weeks. Instead, what we try to do is look at these almost as like different regimes, right? We could be in a Democratic sweep. We could be in a Democrat president with a Republican Congress. We could be in a Republican Congress with what did I say? The reverse of that. We could be a Republican president with a Democrat Congress, and we could be in a Republican sweep. Those are different scenarios. And what we try to understand is not which one is going to happen, but how does each of those impact our portfolio? So that once the election does happen, we can kind of understand the impact of it. So it's maybe a little bit nuanced, but personally and as an organization, we just don't think there's any edge in trying to pinpoint the exact specific outcome and make a big bet around that. That's not how we approach these types of scenarios. Also, when I think often when clients are thinking about elections and markets, the question behind the question is, like, are Republicans better for stock market or Democrats better for stock market, right? So we can try to answer that. What we do here is we go all the way back to Eisenhower, to Ike, to his inauguration in 1953. And we take $1,000, we put in the S&P 500. And then we only keep it invested when Democrats are president, or only keep it invested when Republicans are president. If you only keep that $1,000 invested when Democrats are president, it becomes $62,000. If we only keep it invested when Republicans are president, it becomes $27,000. So does that mean that Democrats are better for the market? And I'm wearing a blue shirt and a blue sport coat, but please don't interpret that as any type of endorsement of any kind. Look, the answer is of course not, right? Like, what happens if we take a step back? Let's zoom out. What if you just stayed invested the entire time? That $1,000 invested for the entire time would have turned into $1.7 million. Well over an order of magnitude better than just being invested when Democrats are president or just being invested when Republicans are president. It's not even close. It's not even in the same ballpark, right? So that's why sometimes, that question, we think respectfully, it's just the wrong question to ask, because markets go up under both. You can see that here as well if we just look at average annual returns. So average annual returns under Democrat presidents has been about 14.5%, under Republicans about 11%. So again, does that mean that Democrats, are better for the markets? Well, look, it's not like the first day that a president is inaugurated, all of their policies are immediately implemented and propagate through the system, right? It's like we were talking about with the Federal Reserve. There's a lag that takes place. So what happens if you run the same analysis but lag it by a year? In that scenario, the Republican president generates more returns historically, right? So again, markets go up under both. You can kind of slice it and dice it a myriad of ways. But in all of the factors that matter for stock market returns, especially over the long term, the president or the party of the president is just not that important of a factor, honestly. This is kind of the classic, mountain chart. Sometimes it's referred to. This goes all the way back to FDR. And what we've done here is just simply overlay this mountain chart with, our historic presidents and their political parties. What I love about this is even big events, like this is 2008 here, when you zoom out, even that's pretty small, right? But something else has struck me looking at this. I saw an interview with Jeff Bezos, right? Obviously the founder of Amazon. I saw an interview with Jeff where he said, I always get asked the question, what's going to be different in 10 years? And I never get asked the question, what's going to stay the same in 10 years? And I actually think that second question is far more important than the first. And what Jeff meant by that with respect to Amazon's business is he has no idea what products we are all going to want in 10 years, but he is pretty darn sure we're going to want those products delivered to us faster, delivered to us cheaper, and the products themselves to be cheaper, right? That's never going to change. There's never a scenario where somebody wants something delivered slower and more expensively to them, right? So that's how he built his business around that principle. If you think about that from a market perspective, look, the president's going to change. The party's going to change. Ideologies, policies, all of those things are going to change. But what does not change is that on average, over the long term, the US stock market goes up by about 10% per year. That doesn't mean it goes up 10% every year, right? You never get the average return. You never get the exact average return. But I think that's something you can kind of bank, right? That's something that doesn't change is over the long term, the US stock market in nominal terms is average about 10% per year. So it's way more important to borrow Jeff's words, to focus on what does not change than focus on what does change. Interestingly enough, I think a lot of people would be surprised. Presidential election years are slightly better than average return years. So again, the average of all years in the stock market is about 10%. Presidential election years are about 11.5, so a little bit better. The midterm years are the worst. And then, as you might surmise, the non-election years are the best years, right? At almost 15%, which this 2023 was a non-election year, and 2025 will be a non-election year. But I think it can be surprising that actually, on average, a presidential election year is a better return year than just an average year. Interestingly enough, though, when we look at flows in the industry, flows into money market funds, and a money market fund is basically, you can think of it as a cash instrument, so it's cash. So flows into money market funds are about double in presidential election years than non-presidential election years, right? So let's just compare and contrast that. The returns are better in the stock market in presidential election years, but more people are moving to cash in presidential election years. And again, I think that speaks to it's very difficult to time, and there's a lot of uncertainty. There's a lot of emotion associated with this, but this is one of the things that ultimately does drag on returns for clients. What we want to see looking through this lens is that there's not a change in the amount of money market flow, but in fact there is. We can also look at this in terms of the monthly returns. So take all of the presidential election years, going back again to Eisenhower, and look at every single month, do the average of every single month. So the worst months in an election year are September and October. Interestingly enough, September is the worst month overall. In any year, September is typically the worst month. But October is the worst month in an election year, and I think that makes sense, right? Because there's a famous saying, the market can only focus on one thing at a time, and it heavily focuses on the election, really close to the election. So That's the time period we're in right now. Although markets have been doing pretty well this October. But historically, right, this is kind of the peak uncertainty. The market doesn't like uncertainty. This is peak uncertainty. But then the best months in an election year are November and December. And why is that? It's because we have the election, that uncertainty reveals itself, and we move forward. But I can kind of guarantee, I think there's going to be a lot of folks, I think half of an advisor's clients, let's say, half of an advisor's clients are going to wake up on November 6th and think the world is ending, the sky is falling, I better get some or even all of my money out of the market. I don't know which half of the client base it's going to be, but it's going to be half. And again, that would be the worst time to potentially do that, right? As you can see, typically the best months in an election year are November and December. And then, of course, again, we're heading into one of those odd years in 2025 that has no election, that typically are the best average years when viewed through this lens. So it's very important not to kind of fall prey to that, if you will. Also, interestingly enough, what if I could definitively tell you who's going to win the election? Is that enough information for you to even make money? And I'm not sure that it is. I'm not sure that it is. And the evidence of that is if you look at what happened in the Trump and Biden administrations. If I had definitively told you in 2016 that Donald Trump was going to win, and I had definitively told you in 2020 that Joe Biden was going to win, I think the vast majority of investors would have said, I want to own traditional energy stocks under Trump, and I want to own clean energy stocks under Biden. And in fact, the exact opposite result has happened. Clean energy stocks did phenomenally well under Trump, whereas traditional energy stocks actually declined. And under Biden, the reverse is true. Clean energy stocks have fallen by 50%. And interestingly enough, the number one performing sector under the Biden administration has been energy. I think that would surprise a lot of folks. This is the most extreme example of if I told you who was going to win the election, is that enough? Like the results can be counterintuitive. The reaction can be counterintuitive. You can see this in financials. You can see this in tech. Financials have done better under Biden than Trump. That's a little bit counterintuitive. Technology stocks have done great under both, but did better under Trump than Biden. Again, I think a little bit counterintuitive. So even if you knew the outcome ahead of time, even if you had tomorrow's newspaper today, I don't know that you can actually consistently use that information to even make money in the market, which again may be surprising, but I would submit to the audience the vast majority of investors would have gotten this trade completely backwards, even if they knew the election results. And that's why we say that this is a behaviorally dangerous year. Over the long term, and this is a study that Morningstar publishes publicly and annually every year, we call it Mind the Gap. So if you search Morningstar Mind the Gap study, you'll be able to download this information. But over the long term, investors underperform investments. Investors underperform investments. Why? How is that possible? Why does that happen? It's because of the behavioral. What you want to do, of course, is buy something low and sell something high. But we're all human beings. We all have emotion. And what a lot of folks end up doing is they buy something high, right? They pile in after the returns have looked great. Everybody's super excited about it. And then that thing rolls over and they ride it down. And then they don't sell it till the bottom, right? Till kind of that panic sets in. And that's obviously the opposite. But this is why investors underperform investments. It's the behavioral, it's the emotional. And that gap is about 1.7% per year. 1.7% per year, which is large, which is really, really large. If you were an active manager and you could deliver an extra 1.7% return per year, what we would call excess return, or you may be familiar with the term alpha. If you were an active manager and you could deliver 1.7% extra return, it sounds like a small number. You would be the manager of the decade. You would have all of the money. Like in investing world, this is actually a huge number, a huge number. And interestingly enough, the very single worst place that clients do, where investors underperform investments the most, is in sectors or in thematic equities. So I think a good example of this today is AI, right? A lot of clients did not get, if you've owned NVIDIA for 5 years, God bless you, you won the lottery, maybe take a little bit off the table and have a nice vacation. But there's a lot of folks that are getting into NVIDIA today. And I'm not saying NVIDIA can't keep going up. Maybe it can. Maybe it can. But traditionally, this is what happens. And that's why, I said 1.7, and this is percent per year, right? Percent per year. I mean, 4.5% per year gap is astronomical. It's humongous, right? In terms of the underperformance. And it comes from, folks sort of trying to time things. Now, on the subject of timing the market, this is one of my favorite stats in all of capital markets finance. It blows my mind. It blows my mind every time I look at this. You may have seen it before. Morningstar's not the only company that has this information. Sometimes when you see something a lot, you can be desensitized to it. But it's really amazing. This is the S&P 500, 25 years of the S&P 500. Does anybody know out there how many trading days there are in a year? How many trading days? I'll give you a second. Think of a number in your head. How many trading days in the market are there in a year? The correct answer is 252. There's 252 trading days in a year. So 252 trading days, 25 years. It's dangerous to do math in public, but I think that is 6,300 days. There are 6,300 trading days represented on this slide. And if you owned the S&P 500 for all 6,300 of those trading days, your $1,000 essentially became, let's say, 4,000, almost 4,000, right? You almost 4x'd your money in those 6,300 trading days. If you missed just the best 40 days, and 40 out of 6,300 is 0.006% of days. So 1/2 of 1% of days. If you miss just the best 1/2 of 1% of days, you go from 4xing your money to losing over 50%. That's incredible. It's bananas in my mind, but I promise you this data is true. This data is true. And of course, when do all of the best days happen? They happen right after all of the worst days. They cluster together. And so this is why we think it's really important to not try to time the market. This is not a commentary on anybody's intelligence or their savviness or anything like that. You will not do it well. And we won't do it well either. We are professional investors at Morningstar. We have a tremendous amount of depth of research and resources and tools and analytics. We won't do it well. And so we don't try to. That's the point. We don't try to. I think I will submit to everyone here. I think you are far, far more likely to do long-term permanent damage to your portfolio by trying to trade around the election than the candidate that you don't support winning and their policies impacting your portfolio, right? So I think you're far more likely to do damage to your portfolio waking up on November 6th and saying, hey, I'm a Trump supporter and Harris won, or I'm a Harris supporter and Trump won, and I want out. That is way, way, way more likely, in my opinion, let's say at least, to damage your portfolio than just accepting, the economic policies, let's say, of the candidate that you didn't support. So, key takeaways, predictions are hard, especially about the future. Everybody loves Yogi Berra. I love Yogi Berra. I actually sat next to him at a restaurant one time. Pretty cool. And predictions are hard, especially about the future, is maybe my favorite Yogi Berra quote. I think it's also important to remember, look, the media has a responsibility, and I'm not trashing the media, but you got to think about what their incentives are. They need eyeballs, and what generates eyeballs is sensationalism. And in a lot of ways, it's negativity, right? So I'm not saying don't pay attention to the news. What I'm saying is just remember that, what you need to focus on in investor is actually what's happening at the company level, right? You want to be listening to what companies are saying. You want to be looking at how the market and the economy is doing. That's ultimately what matters for long-term stock market returns. And when we look at what companies are saying today, and this is just sort of a sample of a couple of major household name companies, like we're seeing positive, they're talking positively about their business. They're talking positively about the economy. They're talking positively about the future. I think that matters more than just the constant bombardment that we get every day from the news cycle. As mentioned at Morningstar, we have over 300 billion in assets under management. It's a privilege and a responsibility to manage the assets that we do and the assets that we may manage for folks in this audience. We take that very seriously. We have over 400 dedicated research and investment professionals. And I think that's what separates our company. If you've ever gone to Morningstar.com and looked at a mutual fund report or a stock report, in a lot of asset management companies, a lot of firms, the research for those firms is a cost center, right? They have to pay those researchers, but those researchers don't necessarily drive revenue for the firm, right? At Morningstar, the research that we do is actually its own line of business. So anytime you go to Morningstar.com or you sign up for a Morningstar license, like all of that is revenue generating for our company. And as a result, I would submit we have the broadest lineup and deepest lineup of researchers, whether we're talking about asset classes, markets, managers, or individual stocks of sort of anyone in the industry. And our portfolio managers who manage the models or manage the equities that you may own benefit from that every single day. So I hope that was really helpful. I certainly appreciate everyone's time. I think we have a handful of minutes here for some Q&A. So let me transition to the Q&A, and Heath, welcome back. I'll turn it to you.
Yeah, thank you for that. It was really good content. I think that as I was taking notes and trying to whittle it down to some key takeaways, there's so much in that. All of it is, all of that's viable, kind of where we sit today. But I think, like us, there's lots of reason Morningstar thinks to be positive about the markets. And that's not to say that you should be naive to the risks that are out there, but the truth is they're always there, right? So maybe if there's a takeaway in this for me, it's that understandably investors don't like uncertainty. But it's really more about what you need from your portfolio than what the market broadly thinks about it. So it's about perspective. And the comment that Morningstar always makes that I love is the prepare, not predict. From an advisor's perspective, to me, that just means you have a plan, right? So the portfolio should be designed in the context of a plan for investors. And maybe that gives you the conviction to stay invested in times like this, where there's plenty of reason to be a little bit concerned. I had a couple of direct questions come through that maybe speak to that. The easy one I'll address real quick was the question received around this being available. We'll attempt to have this available next week, including a copy of the slides for everybody who attended. But one of the questions, as I was jotting them down, and you spoke to this some, it was around this idea that the markets are shifting, and you gave us some highlights of where asset classes have shifted some, surprise leaders from certain sectors, but none of us are going to deny that, especially since mid-year. I think we saw the market be driven largely by large cap tech. To make this actionable for investors, if you were to highlight maybe a couple of opportunities going into 2025, whether it be just unloved asset classes or investments, and then maybe a couple of risks that also sit out there for the markets going into next year.
Yeah, from an asset class perspective, I think one area you can be opportunistic is actually in the small cap space. We really like small caps quite a bit for a few reasons. One, they're trading very cheap relative to large caps, and also they're slightly cheap relative to their own history. So, if you think about kind of the gap between large cap stock valuations and small cap stock valuations, it basically as wide as it's been since June of 2000, basically the height of the dot-com bubble. So you have to go all the way back to that. And after that point, by the way, over the next 10 years, large cap stocks lost 8% the lost decade. Small caps actually returned positive 60% during that time period. So, large cap US stocks have been outperforming so long that I think people forget that it doesn't come down from the Temple Mount on a stone tablet, that like large caps shall outperform everything else, small caps included. Also, small caps traditionally, the start of a rate cutting cycle is generally a very good thing for small caps because being a smaller company, higher interest burdens, higher interest you have to pay on your debt can be a bigger drag on your overall results than it is for a larger company. So So typically, the start of a rate cutting cycle can be a good thing for small caps historically. So I think those are a couple of areas, or that's one area that we do find attractive. I would also say, parts of the there are parts of the banking sector that we have liked recently. Following, and our job sometimes as investors is to be a little contrarian, and so we had all those problems with Silicon Valley Bank and First Republic. Last March, those two large banks went under. But at that time, like, all banks got kind of thrown out with the bathwater, if you will. And so we were able to find some interesting opportunities that we thought didn't have the same exposure, didn't have the same client base, didn't have the same mismatch in assets and liabilities that those banks did. That has performed very well. I think there's still a little bit of room to run there, but some of those areas have come back. On the risk side of the ledger, in the short term, I think, like, not having a clear winner of the election would be an issue. I think it would create a lot of volatility in the market, but I actually might look to buy on some of that dip. It's not the first time that's happened. It obviously happened with Bush. So our view is that we're going to have a president that's going to be fine, but it may not be known that specific day. I think longer term, you just want to continue to watch inflation. That's going to be the main key for the Fed and then ultimately for markets. So our base case is that it's continuing to trend down. But if I was going to kind of just pay attention to, like, one maybe, like, myopic metric, I think just anything that reaccelerates inflation, tariffs being one issue I talked about, would probably be, like, the primary market risk over the next 12 to 18 months I would be concerned about.
Yeah, those resonate. I was jotting down notes as I was kind of fielding these, and small caps was the first thing. I guess from an advisor's perspective, part of what you're looking for are asset classes that are underrepresented in clients' portfolios. And small caps have certainly been one of those asset classes, understandably so. The performance maybe hasn't been there, but I think people are often surprised to find that small cap value long term can be the best performing asset class, and yet it's the part of the portfolio we most likely skip over when we're putting portfolios together. And then I think a shift in how we think about owning bonds and diversified portfolios, that's another asset class that has been underrepresented, it seems like, as clients walk into our office, that I think at least deserves some consideration and attention as you're thinking about, for those of us who think of ourselves as diversified investors, want balanced portfolios. It seems as if some portfolios have fallen out of balance over the last few years, and there's some opportunity there. The other question I jotted down actually kind of ties into this one, because it was more a question around the risk that individual investors face. And I think you really hit on this well in your presentation, in that I think trying to predict external risks is very difficult, if not impossible. But what you can manage is how you kind of internalize or handle your own portfolio or your own decisions. So to me, it's more the behavior risk. But I'll turn that to you and say, as an individual investor, if asking you that question, what are the things that I should be mindful of going into next year? What are the biggest risks maybe out there for me as I'm making investment decisions for my family?
Yeah, so it's funny because I think the known risks are not going to be the thing that creates the next crisis, right? The next crisis is always the unknown, not the known. And that's almost by definition, right? So, I mean, what are some, like, we have two major wars going on right now, as an example, especially the war in the Middle East. If that were to expand, if the US were to get more involved, if that becomes a broader regional conflict, I think that would be could be a negative for markets. In the short term, none of those economies are that large, right? So that they're just not that big a portion of global capital markets. But I think if that expands into a bigger regional conflict, that could be an issue. But again, that's kind of one of the known, I'll call that the known unknown, right? We know about it, but we don't know how it's going to play out. I do think, and I'm just going to advance for this QR here as well, as we're getting close to wrapping up. I do think, though, that the hard thing about answering that question is almost definitionally the big crisis is going to be something that we're not talking about today. And by the way, like, this is all, and this has been helpful for me emotionally to think about it. this is a feature of markets, not a bug of markets. And what I mean by that is, if there was no risk, if there was no volatility, if there was no uncertainty, there would be no return. We would all have treasuries. Like, the return comes from the uncertainty. The return comes from the risk. They're inextricably linked in a way. And so that, to me at least, has always helped me kind of try to better center myself, is like, yes, this volatility is happening, and yes, it's painful, but this is the game that I signed up for. And it's also like, this is where the return ultimately comes from too.
Yeah, I'll leave it at that. We're bumping into it. Let me just thank everybody who joined us on the call today. And Michael, thank you for taking the time to do that for all of us. For those of you that need more information, if you happen to already be working with one of our advisors, I would direct you back to them to continue this conversation. For those who do have questions, though, that we didn't address today and would like to have a conversation, on your screen there, you can get access to all of our advisors through the web link posted, or use the QR code to get more information and get connected as well. So with that, Michael, thanks again. Everybody else, thank you for joining us today. I hope you have a good rest of the afternoon.
Thanks, everyone.